Hey guys, this is Jun Hao from CGH Financial Planning. I'm a chartered financial consultant, and I'm on my way driving to a company talk right now to share with them about personal insurance, about risk management. And one of the topics that I'll be sharing is about the four ways of risk management, the four different types. Okay, and basically, insurance planning is a form of risk management. So I think in order for us to understand insurance well, we got to understand the concept of risk management. Okay, the four ways. First way is actually risk avoidance. So let's say, for example, if you are afraid of being knocked down by a vehicle when crossing the road, then don't cross the road. That's the easy way, right? So you avoid the risk. In that way, the risk don't happen. Like if you are afraid of the risk of, let's say, skydiving, don't skydive. But of course, day-to-day living, there's no way for you to avoid most of the risk. The moment you step out of the house, there's risk everywhere, right? Even in the house, in the comfort of the house, there's a risk of fire breaking out. So risk avoidance may not be practical in many approach, but of course it is the safest way. The second way would be risk reduction. Let's say, for example, if you're worried about getting knocked down by a car when crossing the road, then use the pedestrian crossing or the traffic light. That will help you to cut down your chances of having a traffic accident. Similarly, let's say if you're worried about getting maybe chronic diseases, then exercise, eat healthily, lead a healthy lifestyle, and you'll cut down your chance of having maybe a stroke or a heart attack. So that is risk reduction. The next way would be what we call risk retention. Risk retention simply means you retain the risk. Okay, you absorb the risk on your own. These are usually for things that are low in financial impact. Example, a flu and a cough. Okay, maybe you go and see a doctor. The most it costs is $50, I think. Yeah, so these are the risks that you are able to absorb on your own. The fourth way is what we call risk transfer. Okay, for example, things that are very high financial impact, maybe for example an accident or hospitalization or maybe a cancer. Okay, these are the things that maybe it costs too much for individual to retain the risk on your own. These are the things that we will use risk transfer. Simply means transferring the risk to somebody else. Okay, so insurance is actually a form of risk transfer because you are actually transferring your risk, financial risk, to the insurance company. Of course, in exchange for something called a premium. Okay, so a small price called a premium. So risk transfer is actually very, very efficient. It's a form of leverage for you to get a high amount of risk cover for a very small little premium. Well, I'm almost at my destination now, and I hope that in this short little clip I've shared something of value with you. And if you happen to have a company, or if you are in the HR, or if you know someone who is in the HR, and if you are interested in having a corporate talk about personal insurance, about employee insurance, okay, do ring me up and we can discuss to see how we can take this further. From now on, have a great week ahead. Thank you.